This is your host, Pete Moore, and I am pleased and humbled to announce the launch of my one and only book titled Time to Win Again, 50 Takeaways from Playing and Watching Team Sports to Guarantee Your Business Success. Those of you who know me personally, and anyone who listens to Halo Talks for any length of time, know that I am an avid sports fan and a big believer in the value of team sports. What I've seen over the past 25 years helping businesses grow, raising capital, being an entrepreneur myself, and coaching and mentoring executives in the sector, it's the lessons learned on the field perfectly apply to business. Entrepreneurs, executives, managers, you name it. Every company that's a strong company has got a good team. It's a quick read. There's awesome illustrations in there from our good friend Mark at Cruelty Free Cartoons. If you go to integritysq.com, enter your email address, and we will send you information on the book and the Entrepreneur's Survival Kit as well. Be great. Take names. Go Halo.
This is Pete Moore on Halo Talks. I have the pleasure of having Sharon, Equity Research, William Blair out of Chicago. We were able to be on a speaker series with Rick Caro earlier this year and wanted to further educate our Halo Talks audience on what the real public markets look at when it comes to companies, and have Sharon give us some of her views on what the future will look like. So Sharon, welcome to our Halo Talks.
Thanks for having me, Pete.
Great. So from a standpoint of just educating people on, what you do every day when you wake up in the morning, business related, and tell us, how you think about what the future looks like and how to price companies. If you can just give us a little primer.
Yeah, well, it's a big question. So, I mean, as with, I think everybody's profession, no 2 days are the same, right? But in a nutshell, we're trying to analyze business models, ascertain some sort of fundamental value for that business model. And, if it's publicly traded, that equates to a buy or sell on a stock. One of the interesting dynamics, I think, that is often overlooked in the equity markets from those that are outside of our ecosystem is just why some companies get, an X valuation, whereas others get a Y. And, growth is really important in terms of the way that investors look at valuations. And that's why you'll see some companies get, valued on a multiple of sales. And you'll have other companies that are trading at an EBITDA multiple or an EPS multiple, right? Because with the multiple of sales, you're looking at eventual EBITDA, hopefully, right? That's what's discounted in there. When you're looking at EBITDA, it's typically a more mature company. But the growth dynamic tends to be, where the higher valuations come in and the more disruptive companies.
Yeah. So you take a look at some of these companies that have gone public in, whether it's a SPAC transaction or it's electric vehicle, autonomous truck that as a driver on the 405 scares the shit out of me, that there might be somebody in a 18-wheeler that doesn't have a driver in it. It's controlled by computers, and those are valued at 25 times 2025 revenue. Who starts with the financial model? Do they send it to you and then you guys kind of sensitize it properly, or are you so deep in a market that you kind of come up with your own projections, based off of the company's business model?
Yeah, well, personally speaking, I'm always coming up with my own projections, right? I mean, I don't know how I would earn my bread every day if I didn't come up with my own projections, because ultimately, for the companies that are already public, most of those companies give guidance.
Right.
And so they'll say, we're expecting $1 billion in revenue or $2 in EPS. And at that moment, when that is said, the assumption is that in a purely efficient market is embedded in the valuation. So what you're really looking for then is, where's the surprise? Better or worse than what the management is guiding to. So I think any analyst worth their salt is doing their own modeling and trying to figure out really where the risks lie and where the opportunities are.
As companies go public, and then they're obviously answering to people like you to say, hey, this is what we did, and here's why this didn't happen, or we had an upside surprise, which some companies I think live by trying to provide upside surprises or sandbag their guidance. Do you feel as if companies are appropriately managing quarterly earnings and also long-term growth, or when you're a public company, do you kind of have to maybe make some more trade-offs that you don't have to do as a private business?
I certainly think as a public company, there's more of a balance between investing for the future and harvesting profitability, right? Mm-hmm. So, the go growth at any cost is usually best done private, and then start to see some improvement on the profitability metrics, once a company goes public. But I don't know beyond that there's anything I would really add. Okay.
Yeah. So some companies, like in the health club industry, we always hear of, monthly closeouts. That's kind of, what most health club operators talk about. On private companies held by private equity firms, they're usually talking about annual growth. And then in the public markets, it's either, they've got a ticker that's going off in the lobby showing you what the stock price is, which I don't know if that's good or bad for employee morale. I guess, pretend that the LED screen doesn't work when the stock's going down, I guess, and keep it up.
I do think ultimately, as a management team, you need to keep your eye on the long term, right? We in the financial markets are going to look at the quarters, because we always say every quarter, 4 quarters make up a year, 4 years make up, 4 years. But if you're sacrificing your long-term goals to reach a quarter, that's not a win for anybody, right? So ultimately, management should be playing the long game, whether they're private or public. But I think in the public markets, like if you had, let's just say Pete's Fitness Clubs had a great new initiative that was going to take your margins down, 10 percentage points, probably best to do that over a multi-year period, as opposed to just announcing to the public markets, hey, guess what? Our margins are going down 10 percentage points next year. That would be something in the private markets, maybe just rip off the Band-Aid and you do it.
Right.
But unless there's a strategic kind of competitive necessity for you to do it publicly, it behooves you to spread that out and try to create more predictability for your investor base.
Yeah. So in a nutshell, we're basically managing the long-term growth and the profitability of the company, but really having our equity stakeholders that we've decided that we're going to be a publicly traded company, that we basically have to manage their expectations and what they think about what we're doing and yourself, versus the luxury of having a private company, but not the liquidity of being able to do acquisitions with currency or raise money much easier than in a private deal. So just wanted to kind of cover those trade-offs. As changing gears, if you take a look at the home equipment business, and it's been around for 35, 40 years at this point, whether it's a total gym commercial that changes slightly every 5 to 10 years, or it's just the same people that they had on there with Christy Brinkley and Chuck Norris. And then you see all these new competitors come along. In a lot of industries that I've been a part of, you've got, somebody saying, hey, I'm going to be the next Uber, or I'm going to be the next Peloton. Typically you're not actually. So how do you kind of calibrate market euphoria with, your history of saying, look, the first to the market actually gets a lot of the spoils. And it's going to be really hard to either replicate or displace, or how do you kind of look at it with a white piece of paper all the time?
Yeah. It's interesting because I don't know that I think the first to the market always gets the spoils. I get mocked for having a Yahoo email, and I know you have AOL emails, right? So I'm telling you how old I am.
Fair point. Yeah, same here.
Older than you. And I remember when Netscape went public, so that really makes me a dinosaur. But I think first mover advantage is important, but it's only important so long as you can maintain your flywheel and maintain your innovation gap relative to competition. I think any any industry that's worth being in, once you open up the kimono and you let everyone see how good your business is, there's going to be more competition, right?
Right.
And so it's just always that element of, can you stay ahead of a more competitive backdrop? And I don't think that matters if you're looking at SaaS or fitness clubs or, restaurants. It's kind of all the same animal. I think there are certain aggregators that get a flywheel effect a little bit more easily, and that's a little bit more sustainable. But most of what we talk about involves actually, in some way touching the consumer, whether with a product or an experience. And, that's just inherently more difficult because there are so many more opportunities to disappoint the consumer. And I think that's something that, if I went on Expedia today and I got a hotel room at Marriott and the hotel room wasn't great, I don't really blame Expedia. I blame Marriott, right?
Yeah.
And so the aggregators in many ways don't face any of the pain that the actual consumer brands do. And I think it's especially tough, in fitness, because there's so much opportunity to both impress your consumer, but also, to, I think, add elements of friction that the consumer then, finds the next thing that they're interested in.
Yeah. So as the, I remember when Netflix went public as well. So I'll date myself there. When you look at the speed of technology innovations and new versions of applications coming out, or, a new technology that we never heard of, like now people are talking about, fitness holograms, because of something that, Zuckerberg, said a couple of days ago. And it's like, okay, like we're just trying to actually get cycling instructors physically back into a club. And now we're talking about, hologramming people from, somewhere around the country. So does the speed of innovation sometimes make you say like, oh, it's like these companies must be exhausted trying to like out innovate each other? Or do you think, hey, all this innovation, at some point the winners are going to be established? Or are we just in a cycle of constant, upgrades and improvements? And I don't know. I'm a little bit exhausted sometimes when I think about the technology cycle.
I feel like there's a difference between consumer-led innovation and just innovation for innovation's sake. Like, I don't know anybody who's ever sat around saying they wanted a hologram of somebody in their house, doing fitness. So, but I do hear, consumers say like, look, I'd like to have more variety in my fitness, regimen, and maybe connected fitness along with a studio or a gym provide me that. So I think, solving real problems is something that sometimes tech doesn't do well. I mean, tech sometimes just creates these consumer need states that nobody actually ever had. And then, we get kind of off on a tangent. But I do think, kind of going back to connected fitness, I do think it, going back to consumers really liking variability or variety in their in pretty much all aspects of their life. I mean, that's going to be the big question with the new era of fitness at home is, does it create enough variety and variability that the life cycle of that product is longer than, historical products in that arena?
Yeah, no, that's a great point. Switching to a subject, and it's been kind of top of mind here over the last several weeks, is we've been talking to a lot of groups on the health club side and operators, and they tend to not know enough about their competition. They don't know what the current promotion is. They don't know how many square feet the other club has. They don't know what the amenities are. They don't know who the top salespeople or top group exercise instructors. So we're trying to harp on, like you got to research your 3 to 5 mile radius better, and you got to really be the expert. And you got to know everyone that's doing anything in that Halo sector at large. Could you talk for a minute, just as an analogy, when you look at a company and you put out an initiating coverage report, how much work goes into a coverage report on a company? How much do you feel like you need to know, everything you could possibly know? And as an example, like in the health club industry, how important is it for you also to understand what's going on in the healthcare industry and what's going on with the Medicare? And, you can kind of build up this research that gets pretty broad, but then you really become an expert. So maybe give us a little bit of how you as a top research analyst thinks about research versus what other people should think about it.
Yeah, well, I don't like to be wrong. So because I don't like to be wrong and the market's going to tell me if I'm right or wrong every day, I try to really overarch, on the research side and know as much as I can. So at least, if I am wrong, I felt like I had a foundational aspect to why I had the opinion and the recommendation I had. And I think, what goes into all of that is you talk to management. So that's kind of step one, right? You never should initiate on a company without talking to a management team. But then you're trying to peel back the onion. So you talk to competitors in the arena, the area. A lot of managements are well known within their industries. You get more opinions on them. How long term is their thinking in terms of the way they strategically look at the business. How defensible is the moat around their business? If you opened up Pete's Cycling and then I talked to someone next door and they're like, I'm going to do everything Pete's Cycling does tomorrow and I'm going to do it $5 less per class, I'm going to be worried about taking you public, Pete. So sure. I think all of that goes into the equation. But ultimately, the best companies tend to be masters of their own destiny, right? The companies that grow markets, that are real leaders, that are addressing real consumer need states that for some reason were not addressed well previously. I think those are really interesting companies, as well as those that just keep a narrow lens on who their customer is. I feel like there are so many companies that want to be everything to everybody. And inevitably, they leave some people behind because they're just too broad, like an inch deep and a mile wide. Whereas the brands that really know who they're going after tend to get that top of funnel, much wider.
Yeah, no, that's great assessment. I like the fact that you just don't want to be wrong, and that, and probably in our sector, that's probably the leading indicator on how people feel. Like, hey, was I right or wrong about this month or about what was going to happen? So, post COVID, do you feel companies are better set up now for success? Maybe they've kind of reanalyzed their expense structure. Any thoughts on what the future might look like on working from home? Or it seems like there's a big urge for people to get back into the office, which I agree with.
Yeah, it's interesting. I feel like every day you hear another CEO come out and say everyone back, by Labor Day. And so I think there are some sectors like the financial sector that I'm in that are at the laggards, but I feel like we're in the not too distant future going to largely be more or less back at the office as a nation, hopefully, knock on wood, that not some sort of, new outbreak. I do think that, as I think about the fitness space specifically, there's kind of two different sides here, right? I feel like the consumer wants to get back to quote unquote normal as fast as possible. Right. If you look at the restaurant industry, restaurant sales eclipsed 2019 in both April and May, and they'll probably do so again in June, right? Across, 83% of the restaurants that are left. And it's not too dissimilar in the fitness space where, 15 to 20% of fitness facilities went away. I think the question will be on the labor side, especially for studio-based businesses, right? Labor is just really, really tough. Mm-hmm. And it's probably the toughest labor market that I've seen in 20 years of doing this.
Mm-hmm. And then from an inflationary standpoint, I feel, when anytime I look at an invoice or even like go to DoorDash, I think they might be padding it, but there's all these different charges here.
There are new restaurant charges here. And, you have to actually look at your restaurant bill. They're adding credit card charges now. And that never happened.
So there's like either embedded inflation or there's embedded fees in order to, mask inflation. So, where would be places to invest, in what you cover that, maybe good places if there's more inflation, or maybe groups that could take more fees and just kind of mask it as inflation?
Yeah. Well, I think, strong brands usually have pricing power, right? So if you're a strong brand in any sector, you're probably going to be able to take price to at least help offset inflation. I do think companies that were in the fortuitous position of not having to furlough employees in 2020, and I know that was easier said than done, they face less hiring pressure, here in 2021 as demand surges back. So they're not as crunched, when it comes to that labor pressure. But there's no easy answer, but I think any operator will tell you that sales will solve a lot of problems, right?
Yeah.
So if in the fitness space, if it's a laggard of what we're seeing in some other earlier opening industries, then inflation will be a small worry because the revenue will come back pretty quick.
Gotcha. So in closing here, do you have any good quotes that you live by, or anyone that comes to mind, or things that you say?
No, but I really, really miss getting my morning coffee every day on the way to work. So I can't wait to start off my day with a big old cup of not homemade coffee.
Start your day with a cup of coffee and don't be wrong. That's going to be the quote.
Don't be wrong. Yeah.
That we're going to be put on there. Awesome. Well, great to see you again. We're going to get this out over the summer. Look forward to seeing you at future trade shows. Great. And if we can be helpful with any research on the ground, happy to help frame your collection of information at any time.
Thank you. I hope this was useful for you guys.
Yeah, awesome. Appreciate it.
Take
Have
care.
a great day. Bye
Bye-bye.
now.